If you start thinking about this every day, I want to exit, I think you kind of get counterproductive, right? When you go into an entrepreneurial mindset, I think your number one thing you need to tell yourself is, I'm here to build a great company, and I'm not going to have it straightforward. Good businesses are always simple and not easy. I think there's some three principles. You have to start to know when to say no. No to time sucks, no to bad quality revenue and traction, and do not fall into the cash flow trap. You're here to optimize for valuation, not for cash flow. Poor quality cash flow can kill your business a lot faster. It's all about quality of revenue and quality of traction, not any traction.
This episode of the Raise and Exit podcast, and today with us we have Nitin Kumar, who has recently semi-retired. He has retired from his experience in doing a lot of M&A, and I feel very privileged that we are able to have him and reflecting on that experience that he's gone and learned over that time. But that is just a very short introduction. Nitin, over to you. Please give us a bit more context to your background and your experience and why you went and publicly announced your retirement from being involved in M&A.
Yeah, so Edgar, I've been in business for about 30 years, and I had a very unusual journey from running large things in large companies, multi-billion-dollar P&Ls and thousands of people. From there, I came into the new economy. This has been my third startup. I've had 2 exits. I think once I move on from a specific thing, I tend to not go back to it, right? My first career was in cybersecurity. Second was a management consultant, then M&A, and then legal tech, right? So that I retire myself and then go build a new.
That's great. And you've been through so many deals. And part of the theme that I want to kind of have around this is around the notion of, look, there's probably at some point you're going to need to exit as a business. But I think the question that I have for you here is, how do you balance, or what would you give as guidance or coaching to people to balance, to focus on sustaining their business, not just looking at the exit all the time?
I think, look, there is multiple ways to think about it, right? As an entrepreneur, if your goal is to exit someday, then you have to optimize for that. But if you start thinking about this every day, I want to exit, I think you kind of get counterproductive, right? When you go into an entrepreneurial mindset, I think your number one thing you need to tell yourself is, I'm here to build a great company, and I'm not going to have it straightforward, right? Good businesses are always simple and not easy. So you need to just prepare for a life on how do you optimize for your valuation. And yeah, many people are going to tell you many things, and there's a lot of free advice that comes from people who have never done it. That includes a lot of VCs and a lot of advisors, a lot of people who sit in corner offices in big companies and think they need to run a business, but you haven't done it until you've done it. And I think there's some 3 principles. You have to start to know when to say no. No to time sucks. No to bad quality revenue and traction, and do not fall into the cash flow trap. You're here to optimize for valuation, not for cash flow. Poor quality cash flow can kill your business a lot faster. It's all about quality of revenue and quality of traction, not any traction.
I really want you to unpack that piece, because a big part of the theme that we have around this and the work that I go and do professionally as well is on what ultimately drives valuation. And you unpacked a critical statement that's there, which is the quality of cash flow. And I would also want you to add maybe to this is, how do you distinguish between good quality cash flow and bad quality cash flow? Because it's easy to just say all cash flow is good cash flow.
Actually, let's unpack that very simply. So you want predictable and sustainable cash flow that scales without adding cost. That's the number one principle. If you want to go from X to 3X revenue, you can't have 3X cost and 3X headcount. That is good scalability. Second, you need predictability. So your subscription revenue is actually the best, right? Or outcome revenue, which is the best. Followed by that, you have all these things that can contaminate your revenue. Your pristine balance sheet can get ruined by services, one-time costs, support, advertising. And when you're raising, right, some VC will tell you, go build traction. You start to go and do custom services. And then you start to do, Edgar tells me, I want this feature. Nitin tells me, what's that feature? The third guy tells me that feature. You kind of are a custom software development company, and your valuation becomes like services. And this is one of the most common traps that I see founders put into. Your second problem is, every logo is not a good logo. You need predictable cash flow. If XYZ company can, and I have had this before, like a certain large company used to suck out like 80% of the juice of my engineering, right? That's not a good customer. You may get revenue, quality of revenue, but it is like wrench inside your scalability. So learn to run. Good discipline comes from not contaminating the product. Products solve very specific problems. If I'm not solving your problem, I don't think I have product market fit. If you're asking me 9 things that are not on my product and not valuing the 2 I have, don't think I have product market fit. Customer requests are not product requirements. Okay.
Oh,
If
that's gold. That's gold right there. Keep
Well,
going.
requests are not product requirements, and if your sum total of your customer requests outweigh your product requirements, I think you're on a valuation grenade. So if you look at quality of revenue and think about this yourself, we all came from like the software as a license era, right? You sell the software, one-time revenue, get all the cash up front, good cash flow, then you sell support contracts for 80-90% margin. That's great, but you've already taken the revenue, recognized it on your balance sheet, and moved on. An acquirer is stuck with your liability of cost of serving. But if you're buying a SaaS business or an AI business which has a subscription cash flow, at a certain point in time, you are acquiring the future cash flow, not what you have eaten up. So that's quality of revenue. So you think about the greatest one being predictable subscription, not journey subscription, licensing with support annual contract, predictable advertising kind of stuff. And then the last one is the services kind of business, which is very unscalable. And if you fall into that trap of servicing customer requests, I think you are a services company and your valuation is going to go there.
So good. We've had guests on here who've gone and talked about that, a similar type of dynamic that is there, which is, can you actually break down how much of your revenue inside the business is going to just keep generating revenue without you having to touch it? And I think you're pointing to a similar kind of exercise here is, do I need to service this revenue to be able to retain it? At which point you are a tech-enabled services company versus the customer is constantly pulling for that revenue. So I'll add as a follow-up to that then, what are either the signals or what are the minimum questions you need to ask before you fire a customer that is actually impairing your long-term valuation?
I think firing a customer is very hard. I think you need to sort of stem that problem at the intake. That said, we've all gone and done that, but then you have to explain your bad decision. And as long as you can be open, transparent on why you fired the customer, I think the market's going to be okay with that. The question is not about the customer, right? I mean, there are green flags on it. The first question starts from you yourself. Is your product needed and is it solving a problem for X person? And if you say, I'm selling the product to 10 different people, I think you don't have a product in the first place. So especially when you start up. So you have to think about, what does my product do? There are 4 business KPIs, right? Does it increase revenue, reduce cost, remove headcount, or sort of turn your assets lean? And if I'm saving you $100, if I go and sell to your colleague in the next office, that may save him only $60. You're changing your value and your pricing, and that will kind of put pressure on the product downstream. Then the second question becomes is my product used frequently, not one-off? That means you're planting churn. And if your product is not used frequently, then how frequently and what is my cost for that? And if the answer to these are no, and you're spending a whole bunch of management time, calories, your engineering, product team, and sales on that account, I think you're in the wrong place.
Yeah. Can I summarize that then? Because what I'm hearing in this is that churn statement is bang on. I see a lot of companies failing to integrate usage telemetry into their sales and CX organizations. When should a company start tracking telemetry and integrating into their account management or their contract management?
Your first 5 customers you can get by running it on spreadsheets, right? Then if you go a little bit more, then there are parts of the product that scale. Parts of the product are not used. You have to increase the frequency of usage. And now we are even beyond subscription revenue. You're going into usage-based pricing and outcome-based pricing. So if your frequency of usage and value of usage isn't high, I think you have a problem, right? So if you're looking at a PLG kind of a product, you have to start now. Right? If you're an enterprise sales kind of product, you need to integrate the telemetry in probably before your 10th customer because you miss patterns.
Woo. That's so good, because I would say that's a big failure. I love that insight. I appreciate that very much. Nitin, I want to shift to another kind of dynamic that we ask from our guests. And this is, call it, things that were good, but are now a very bad idea. So they've become mythological. So my first one that I have around for you is, what is one exit myth or one raising myth that you wish every founder understood much earlier?
See, your raising myth is that you need some traction. Come back with traction. That doesn't mean you go sell to your neighbor or your friend or or pick any logo and become a services company, right? It has to really be aligned with what problem you solve and how big the problem it is. And is it repeatable with another customer? If you have to change the product for another customer, VCs aren't stupid, right? They're also smart people and they know whether there's repeatability and scalability in that motion. And I'm also an angel investor. So many people come and ask me, hey, I look at this and say, like, guys, this is not traction, right? I mean, yes, you got a logo. Traction really means that you're solving a problem and really well, and your ability to say no is your ability to sort of get funded. I think the second raising myth is that I need to go broad. Go-to-market motions are very expensive. You cannot sell in multiple verticals and to multiple economic buyers and put multiple salespeople. That requires a hell of a lot of cash burn. I think staying focused on a single go-to-market motion with, let's say you sell to a CFO or a CIO, you need to be exactly in that. In a vertical, penetrating deep is more, and it shows value and scale. If you're in 5 geographies, in 5 verticals with 5, 6 different things, you yourself don't know the value metric of your own product. So as long as you're in that zone, I think you will get funded. Otherwise, it's challenging because VCs don't see scale or proof.
Oh, it's so good. My follow-up to that is I think there's a myth in the making today, which is historically was, hey, you're a company, you're going to need to raise, you need to scale, you need to raise again, et cetera, et cetera. What do you think is the actual reality today in the era of Lovable, in the era of AI integrations, the Claudes, the ChatGPTs? What type of companies actually need to raise today? Or when do profitable companies need to raise today? What are the myths that are emerging on that?
So this gets into the philosophical discussion that I always have with people, right? I think you need to draw a line in your head between the old economy and the new economy. And give or take, it's 2020 or 2022, as long as the zero interest rate era passed and ChatGPT and Lovable came in. It again comes down to the thing is that how quickly can you build something minimal and make it useful and usable. You don't need like 20 features and enterprise readiness and all that, right? The second problem right there is that, do you know if your margin can fund your CAC? Okay, building a product. And I also said, don't go to pre-2020 or 2015 founders. Building a product was very difficult, then go-to-market was easy. You are now in an era where it is the exact opposite. Building an okay product, which is usable, is great. It's very simple. Go-to-market is extremely difficult because you have all these tools. You have agentic SEO, agentic ads, agentic email, and all that. And what are these doing? They're going and contaminating and kind of overwhelming these channels, which is raising the CAC. Now, the question really becomes is, can your margin fund your CAC? So if you're an enterprise company, there's a lot of these people go sell at $50,000, $60,000, $70,000. I think it's going to be very challenging if you have a sales-led motion to get your margin to fund the CAC. You need to ask that question to yourself. Where is my CAC, how efficient it is, and that is the dial you turn up and down, and whether your CAC becomes efficient or not. So in the era of Lovable, that is the metric you need to watch very clearly, and is that scalable or not? And then relate that to usage. If you're a Lovable kind of a product, yeah, is my MAU and DAU ratio about 30? That's the time to scale. Below that, you cannot scale. You're going to lose money. Your negative economies of scale will kick in and you'll burn much faster. If your MAU/DAU is around that 50, I think you've arrived in life. Pour as much fuel and capital on it. That's the companies that can raise faster. Look at your CAC, look at your usage, look at your frequency of usage, look at your high-value feature, and look at the MAU/DAU ratio very, very closely. Now, you can be a WAU product, but you get the drift of it, right? You're ready to sort of think about scale. Until then, think about growth. It can be inefficient, but think about growth because you can then make the scale more efficient.
That's fantastic. What is a principle that you think the current generation of founders and capital raisers have lost sight of or are even blind to that you think needs to have much more attention or much more buy-in?
Look, I think everybody's in flux. Let's say that. VCs don't know what they were looking for and what they should look for. So I now have a fashion tech company. I think right now in this world, you need people who don't come with the old economy baggage. So you don't fund a Henry Ford because he didn't know how to ride horses. I think that's sort of the basic thing. And if you're the old economy, you will be a cab company. You want to put a mobile app and you think you're Uber, right? That era is gone. I think you need to disrupt from the outside. So that is very clearly something people are looking at. Second is a wrapper on AI doesn't kind of help you, okay? Because you're a slave to these APIs and costs and all that. So you have 3 business models there. And I think the VCs fall into three of those business models. They fund data brokers, i.e. vertical AI, right? You have deep proprietary data and all that. You have model owners. Now, if you're a scientist with like amazing stuff and you believe nobody can build a model better than you, I think you should absolutely go and do it. But I think model owners need to rethink about what kind of a model. And the third one is wrappers. I do think there is value in it, but your source and sustainability of competitive advantage is gone. Even if you some pieces are wrappers on LLM, I think they need to be powered by either a unique model or unique data sets that you can broker into the market, which is vertical AI, said in a complicated manner. So each of these VCs are falling into one of the three. And if you're not approaching the right one, which is a fit for this business model, the stage you are in, the geography you are in, I think you will not get funded. And then the principles of business don't change. Scale, quality of traction, quality of revenue, do your cost scale with this, can I create a network effect and all that. Hand-to-hand combat, which is a sales guy showing up, is going to be harder and harder. Executives are overwhelmed, and I think your cost of acquisition has gone up. The model is really, you start with PLG, like a Lovable and all these guys, like Canva started, you get to a certain threshold, and then layer on the sales motion on top of it. Now, granted, all products can't do that. So you need to raise accordingly, raise appropriately, and better make sure that the unit economics work, the margin is funding the CAC, and everybody can get multiples on that. The finance of a product is now in the code because you're paying API, you're paying consumption and all that. So you need to be very financially savvy on how that is instrumented. You instrument a wrong product, you kill yourself financially.
That's gold. Right there. That's the tagline that's going in on this episode for sure. I want to shift to another topic, which is kind of one of my myth-busting missions. TAM, as a principle, total addressable market, is about 25 years old today. How has it helped and how is it hindering people going and building companies today?
Look, I think TAM is maybe more than 25 years old, right? It is still a directional principle. But you have to also keep in mind in many industries, the market structure can be broken down with technologies. Just think about is Tesla a car company or is it a data center on wheels? Uber a cab company or is it algorithm on sale that is getting demand from the crowd? So there is a structural alteration. I think you can approximately keep the TAM there as a guiding principle. The main thing is that can I alter the TAM? Am I a TAM changing product? And not has to be. If you're not, then your second degree of freedom is, okay, you leave the SAM aside, it becomes a little murky. The SOM, can I capture 100% of the SOM in 3 years, 4 years, 5 years with this AI? What can I do there? So it's really about how fast can I capture the SOM if you're not a TAM-changing product?
I find those calculations are still way too big. I've talked to companies, it's a $50 billion TAM, we have a $10 billion SOM, we have a $4 billion SOM, and they're sitting at $100 million in revenue. And I'm just like, I'm not seeing how you're going to 40x yourself in 3 years.
No, so it is not like that. That is where the calculations usually go wrong because people come top down. If you actually bring bottom up, and this is one of my tests, if your SOM is landing at about 100 million, right, on a bottom up calculation, go redo your SOM.
So what is a good outlook for 3 years for a responsible bottom up, top down SOM calculation?
No, that's very hard to say because see, each industry has a different tailwind. But I think with the thumb rule of investing is that if, or as an entrepreneur is that if your SOM is above 100 million, I think you're a little bit too broad. Go and redo that. By the way, capturing 100 million in 5 to 7 years is amazing. Okay, you have a $1 billion company ready to IPO and all that. It's also very hard to do. But as a thumb rule, now different industries have different nuances and stuff. But if your SOM is like of 100 million, think about whether I can capture that in 7 years. Yeah, if you have like 30, 40 million, think about whether I can capture it in 3 years. Below that, you get into a niche thing, right? Then the question is that can you ever get to your TAM? So there are no right or wrong answers in this. There is an art and science, but choose these as guiding principles. These are never cast in stone. TAMs are never calculated to a nth degree of accuracy. They are directional. SOM is the bottom up. And can you capture that faster, quicker, efficient? That's the game.
So what stage of growth, traction, product market fit, scaling, whatever you want to call it, should a founding team or a founder invest into systemic market intelligence? Like they're actually going and trying to figure out how accurately have they identified their SOM and are growing into it. When should you do that?
I don't think that is cast in stone. The sooner you do it, the better it is. But see, there is in reality, the operating reality on the ground is investing that too late is a problem. Investing that too early, you develop a baggage. It takes off your degrees of freedom to pivot and all that kind of stuff. The operating reality is a startup may need one or two pivots to get to that product market fit. So you make that a judgmental call on what market you are in. The adjacent markets can become a term, the structure can be altered. Do not do that too early. You will take away your degrees of freedom to pivot and over-index on that. So just keep your mind open and talk to that. At the same time, keep an eye on.
That's very helpful. Can you share, to the extent that you can, both a failure and a success story in, call it, sufficiently well-defined SOM for a company to go and scale? One of each.
Well, you have million AI people coming in today with these agents, right? And agents are not automating the workflow. Now, if you are building, let's say, a legal tech or a food tech company, you're not really automating that. So that SOM really doesn't matter. You're deploying a new agentic workforce there. Now, your calculation is really how quickly can you suck the assets from the old economy and put them in the new. You don't even need to be a food tech ninja today to do that. So your SOM is already kind of thrown off there. And many of these companies have actually failed because they thought they can do it as a more generic part of food tech. Now, big question becomes is that what is food? There is fruits, vegetables, bakery, confectionery, and all that. So what is your real SOM today? Mm-hmm. Because you have AI going in there and you can't be as long as food tech and grocery chain. So I think there's like probably 50 companies that have gone into the graveyard from that sector because you overestimated what you were doing and underestimated the effort that it takes to sort of serve that market. Good successful companies who pivot out are who kind of subtract to add, right? You go narrow and narrow and narrow and your go-to-market motion gets deeper and deeper and then you take that and replicate. If you're trying to go too broad, you're not going to find your wedge. What is that wedge to get into solve that one problem, solve that 3 times, take the one swim lane and then replicate. That is becoming the scale. And then you may pivot, you may find new markets, you may find new business models and revenue models. But looking at like 10 different things and trying to shoehorn them into your SOM is the biggest mistake.
I'd like to kind of close out our time with you. If you can unpack more of your discussions, conversations, both public and private, on the notion of theory debt versus technical debt.
Look, today, technical debt is not considered bad because that's what AI gives you, okay? It gives you speed. You take a little bit of technical debt. As long as you're conscious and you can remove it. Your APIs may be very costly. You may be on an LLM. You may be on a different model and all that. It gives you speed to market and capture that initial slice of SOM. It's hindering scale because your API costs will come and hit you. So I think the theory debt is as it is on the balance sheet. The technical debt has to shift very quickly. And there's good quality technical debt and bad, right? One of them that is kind of manifesting behind the scenes and kind of coming in as that poison pill. But the good quality technical debt, you need to assume that risk. It is part of your operating risk today. So I'm in the camp that some part of technical debt has to be assumed by design so that you can offset it by scale and dollars, right? The challenge here is not understanding where that debt is and how it is going to scale and where it's going to come and bite. That's the problem. As long as you're conscious about it, you can eliminate those aspects.
So your notion of theory debt that you've been referring to, how do you put that into the strategy or the go-to-market of a company?
I don't think you need to worry about that right now, okay, if you're in the first 2 years, as long as you're clear on where it is and what you're going to do and when you're going to do.
So when should a company start pivoting to that? Is that like crossing the product market fit? Is that crossing to sustainable cash flow?
I think you need to just start to think about it when the product market fit patterns start to form, right? Because then you start to scale at a rate that can kill you. So when the early patterns are there, start to focus on that. And also it's a thing that you can eliminate all kinds of debt in one shot, right? You have to phase it and what those trade-offs are.
So tell me a bit more then on it, because it's not something you hear a lot about, right? In terms of work a lot in like spaces around brand, and there's brand debt for companies where they're out of date on the definition. Tell me a bit more of what you mean by theory debt inside this context, because I think you're onto something here, but I'd like for you to kind of unpack it a bit more.
Look, I think the brand debt and the content debt and like all other forms of the debt, right, or what is lying on the balance sheet and that is invisible to you is what I look at. Now, you want to see what content debt is? We're dealing with this today. All our blogs that were like 2024 are now like, what the hell, right? So that's another thing. Those things you need to solve. Your content has to be real. Your brand identity has to be manifested through that and all that. So you can't carry those kind of things. Let's be very clear.
This is great. Keep going.
Okay. So there is When you brought on the brand debt, like we deal with it every day, right? So your identity has to be manifested, your product has to be living and all that. The technical debt is a little this more deliberate. If it's not deliberate, you have a problem. But these are invisible things on the balance sheet that you don't even know.
Oh man. So if I summarize theory debt from what I've gotten read about you, because I thought this was the really cool part of your background, it's when your business model is stuck in the past, but you are giving yourself the false belief that it's still manifesting itself in the present. What is a sign that somebody can go and use to just keep themselves honest with themselves and determine when they might need to pivot?
Look, the first principle is that you need to ground yourself that you're out of the old economy. You are out of the old economy. Old principles, old rules, old advisors, old thoughts break down. And also tell yourself that I am betting on my expertise and I've let go of my experience. So all that stuff you knew pre-2022 are very different. You have to learn to operate in total ambiguity and uncertainty. That is a new economy skill. And by definition, the rate of change is going to be very fast and never going to be this slow again either. So you bet on that every day. Crowds are smarter than you. Let's also be clear on that, right? Do not bring people who tread on their experience. Bet on smart people. They can change. Learn fast, but unlearn faster. I think these principles will help you move quickly, and do not worry about your experience or their experience. There is no guarantee, even in the old economy, that you were in one role, you'll be successful in the other. Same thing applies. One startup success doesn't guarantee the second one. Build something people want. Learn to be comfortable with 60-70% of certainty and all that. Be data-driven to the extent you can. Do not hire people with a lot of experience. Bet on their expertise. Help them let go of their experience. You'll unlock a lot of value there.
Amazing. Nitin, who should reach out to you and why?
Look, I am available for board seats now. I just let go of a couple of them. I'm happy to sort of help in any way that I can. I still do some angel investing. And yes, I'm running a fashion tech company now. So all fashion brands as customers are welcome to have a chat with me.
Nitin, thank you so much for joining us on Raise and Exit.
Really enjoyed
Cheers.
it.
So Nitin, question for me, or kind of what did sharing with us so much for the past 30 minutes kind of reinforce for you, or what is a new idea that you got?
No, I think the questions were geared to something that actually got to my mind, that there is a large number of founders who don't have these support systems or good advice, right? Or they have a lot of these old economy advisors who have never done startups or sit in large corner offices and coordinate business and not doing business. I think these questions are really spot on to serve those people. What is traction? What's quality of revenue? How do you approach things? How do you grow? What is the difference between scale? So I think you kind of hit a market that is unserved right now or underappreciated. Because all the VCs run to like, oh, second-time founder, third-time founder, multiple exit, unicorn guy, and this and that. And there's like a lot of these guys coming in. And I think there's going to be more coming in because building is easier. So I think those questions were really smart and pointed to serve the real granular problem, not high level. So I appreciate the quality of questions here.
Thank you. I took a bunch of notes, which I try and avoid, but there's just so many good things that you said. One of the ones that just screamed out at me was when you said, unlearn faster than learn. And I think that is so good, because I think we get attached. We get attached to our romantic ideals, and we don't figure out how much of it carries forward. Like I look at it as a tree. Like how many oak trees want to remain acorns? They just want to keep growing, right? You got to stop being an acorn to be an oak tree. So that's kind of where things are going for me from that point of view. There's another thing that you went and said, which if we'd had more time, I would have gone into it. But the whole notion of brand debt and how you need to be able to understand the brand and how it's viewed in the marketplace. Maybe you can just share a bit more on your experience around that, especially as you're in one of the most brand-based industries today, which is fashion.
So, look, I think there is also a very different notion of what a brand is, and different people have. It's really a manifestation of your product delivers and the promise of that value, okay? Markets can shift, your product can shift, you can derail from the promise, and then there are pillars, right? Your content can reinforce and your message can reinforce. So you have to really look at that. I can give you a very tactical example. There's like number of brand redos and all that stuff, right? As I was saying, there's a lot of blogs that you put out in 2022, 23. They still generate traffic, right? Don't get me wrong. But it's like 2023, 2024, and your competitors may have generated that better. There's content that has come. AI now writes better. So if you look at it, hey, I, Nitin Kumar, or I, Edgar, wrote that blog, and that's the best, right? That debt is just piling up and growing. So your return on production is getting lower. You're producing more content, but you're getting lesser and lesser. right? And this is how the algorithm also works. I mean, Google's thing was, give me 10 pieces of content, I'll give you 20 pieces of traffic. Now it's like, give me 80 pieces of content. And your stale content is now going to sort of manifest, your trust score goes down. Now it will be 300 content. So you're kind of fatiguing yourself. Are you running or are you on a treadmill? So the sooner you realize, the better it is. And then there's many different ways that these illusions crop up.
And so on that note, I'm seeing this interesting kind of divide as well in the notion of the startup ecosystem or the scaling ecosystem. I'm actually even reluctant to kind of call it a startup ecosystem today. I kind of feel that you can very quickly determine, do you have something there by hopping on Lovable, and probably in a few days you can figure out, do you have something that sticks together, and then you got to figure out that go to market. So another piece that just was, man, I want to unpack this even deeper, and maybe it's a follow-up I'm going to harass you for. But as you went and said, pre-2015, building a product was hard, go-to-market was easy. Now it's the opposite. Go-to-market is hard, product building is easy. What do you think is that one question you have to ask, or what is one question you'd recommend for me to ask in building our business to go and kind of get to that really raw and honest look at myself in that reality?
Is the problem that you're solving real? Do people want it? First question. How big is the problem? Second, how urgent is the problem? If you're not hitting 2 out of the 3, go back to the drawing board. We're all smart people to figure it out. You cannot sell a vitamin. You need to sell a painkiller in the first 2 years.
Yeah, I think that just nails it. It either solves a problem or fulfills a want.
How big is it? How urgent is it?
Yeah.
2 out of the 3 have to be on point. If you yourself aren't convinced about all 3, great, you arrived, right? Chances
well,
are
that's a matchstick in a pile of cotton. Boom, right there.
Yeah, but then look, it's very rare that you get 3 out of 3, maybe in the second or third iteration. But if the answer is that it's 2 out of 3 are wobbly, go back to the drawing board. You'll figure it out.
Nitin, this is great. Thank you for those extra few minutes of wisdom.
Happy to help, and thanks for reaching out. I really enjoyed the conversation and the quality of questions.
You got it. Cheers.